I wanted to watch it.
It will be there momentarily.
Okay, great. Thank you.
And Patricia, thank you very much for your help in organizing and arranging.
You are most welcome. Is there someone in particular I should make a co-host?
Well, Duncan Sinclair will be controlling the slides, so we just have one of us.
Okay.
And in fact, I won't have any control of the slides.
So Duncan, I'm going to make you a co-host.
Yeah, that'd be great.
Thank you. So a co-host besides sharing a screen, does it mean anything else in particular?
I don't believe so.
Oh, that's all I need, I guess.
Well, the time is nigh. It is 3:30 here at Mountain Standard Time, so I think we'll just go ahead and get started, right, if that's all right, and then people can join as they do.
That'd be great.
Okay. All right. Well, I'm pleased to have this presentation today. Thank you for your time. I'll introduce you, Ray, and then you can introduce the other guests as appropriate. So Raymond O'Connor is a managing director of Ramirez & Co., having joined the firm in 2006 in its corporate finance and capital markets group. Ray has over 30 years of energy and power industry investment banking experience. Ramirez, based in New York and founded in 1971 by Samuel Ramirez, is one of the oldest and largest minority-owned investment banking firms in the country. Prior to joining Ramirez, Mr. O'Connor was a managing director in the Energy and Utility Strategic Group of PwC's consulting area, where he focused on project finance and risk management, working with a number of companies, particularly Scottish Power and its UK and US regulated and unregulated subsidiary companies. Previously, Ray worked at JP Morgan Chase and its predecessor firms, where he provided a range of investment banking services to the global energy and power industries. At Ramirez, Mr. O'Connor has provided capital markets and strategic advisory services to a broad range of regulated and unregulated utility customers. In addition to his responsibilities at Ramirez, Ray is a partner of Energy Capital Ventures. ECV is an early stage venture capital firm and is the only VC firm focused on the digital transformation and ESG imperatives of the regulated natural gas industry. Currently, ECV manages 45 million from 5 gas LDCs. ECV has found that through collaboration with its utility partners, it can effectively identify together disruptive companies that the utilities can help to scale quicker, which then uses those disruptive technologies to help their businesses position for a low carbon environment. Mr. O'Connor received his BA in economics from Boston College and his MBA from Northwestern University. Take it away, Mr. O'Connor.
Thank you very much, Chairman Brown. And first of all, let me start out by saying that myself and my colleagues and Ramirez & Company is honored to be able to present our thoughts on ESG and the energy transition this afternoon to the Montana Public Service Commission. We appreciate the opportunity to do that very much. To just start out, I'll start with some introductory comments, and I'll pass on different sections of our presentation to my colleagues. A few years ago at the AGA in Scottsdale, I caught up with an old friend who I hadn't seen in a while. I'd been spending considerable amounts of time in Sacramento and San Francisco, speaking with the California policymakers and regulators responsible for addressing and finding solutions to their wildfire problems, where I was helping them understand and appreciate what it means to be a regulated utility in distress and who ultimately pays for these costs of distress. This friend of mine who runs the energy and utility investment banking activities of one of the large banks, went on to tell me that his business was under some meaningful threat from his management. His bank had just formed an ESG group that was looking at all of its businesses to identify where ESG type risks might exist. Concern arose around a large and controversial pipeline project that they weren't involved in, but had been reported publicly that they were, on which his bank's ESG group had serious questions. Although he had declined months before the opportunity to finance the project, he still got in trouble for passing on this work for business reasons, not ESG reasons. My California meetings made it clear to me that the constituencies being listened to in respect to the wildfires were broad and diverse and included environmentalists, social activists, and good governance organizations, various institutional investor types, and so on. And it was also clear to me that the information my colleagues and I were providing them, they weren't getting from anyone else. After reflecting upon my conversation at AGA and my work on the wildfires, Ramirez, who had been welcomed into the offices of California policymakers when other firms, large and small, had not, resided somewhere on the ESG continuum. Consequently, we decided to make a commitment to looking at ESG in a meaningful way by dedicating significant time and resources to it. There was, and still is, a lot of information from various sources on what ESG market dynamics and characteristics look like in terms of size and breadth. But we haven't seen much analysis on what the impacts of the ESG are on the financial health and operations of industries and specific companies themselves. The work we are discussing today attempts to add something of value to the ESG conversation as it relates to regulated utility companies. Niso Aboif, who has his PhD from the University of Chicago and his bachelor's and master's of electrical engineering from Northwestern University, will speak to the academic literature and the underpinnings of ESG markets and investing. Prior to joining Ramirez 12 or so years ago, Niso ran Credit Suisse's financial strategies group, and prior to that, he was a founding member of Salomon Brothers FSG area. He is also a finance and economics professor at Pace University in New York. Konstantin Semyonov, who has his PhD from Moscow Tech and an MBA from the University of Chicago, looks at the statistical relationship of ESG rating agencies' published scores and various financial and leverage metrics. This is the foundational work which was extended after numerous conversations with various utility companies, suggested that an analysis which correlated data from EEI's newly evolving ESG template to the same financial and leverage metrics could be very useful. Konstantin has been with Ramirez for 12 years as well, and was previously at Credit Suisse and Citibank doing FSG work. Although it took some time for enough of this data to be compiled by the utility companies involved in EEI's ESG task force to derive useful outputs, Duncan Sinclair, who has his PhD in math from Johns Hopkins and his undergraduate degree from the University of Pennsylvania, was able to gather sufficient information to do this work. Prior to joining Ramirez, Duncan was a research mathematician and was a bankruptcy consultant. With that, I'll turn it over to Niso.
Thank you, Ray. Happy New Year and good afternoon, everybody. I would like to refer to our presentation. If we could turn to page 4, Duncan. One of the first things that both academics and practitioners ask is whether being ESG good has any effect on financial metrics. And one of the works that we did here in our group at Ramirez was to answer that question, both ourselves and also by looking at the academic evidence. ESG is a relatively new phenomena, has been around for, I might say, only a handful of years. But the kind of mirror image of ESG good stocks are sin stocks. And the academic evidence on sin stocks is very well established. What are sin stocks? Sin stocks are things like tobacco, gambling, and the like. Clearly, these are risky stocks, and holding such stocks and such bonds usually results in higher expected returns in addition to higher realized returns, simply because they are risky, fully consistent with academic theory in finance. More risk, more return, less risk, less return. The mirror image of sin stocks is being an ESG good stock. So the argument would follow that if you're an ESG good company, your expected return, whether it's a bond return or an equity return, should be lower. The academic evidence on that is mixed. And interestingly, what the academic evidence finds that being ESG good usually results in lower bond spreads, which is fully understandable because that is less risk. So the tail risk, so to speak, is lower if you're an ESG good company. On the other hand, being ESG good does not necessarily mean that you will have higher returns. Again, that's consistent with academic theory. But moreover, we do find that being ESG good and being ESG bad are not symmetrical. If you're an ESG good company, it does not immediately follow that the market will reward you. On the other hand, if you're an ESG bad company, the academic evidence does find that the market will punish you. The analogy that we have here, in the old days when we used to wear a suit to work, if you wear a suit to work, nobody is going to give you a big bonus. On the other hand, if you don't wear a suit to work, if you don't look respectable, you're likely to be punished. So there's the analogy there of being ESG bad versus being ESG good. The academic evidence also finds that the ESG premium or discount is not necessarily consistent through time. So early adapters of ESG, for example, have had better returns than later adapters. And in all likelihood, as the economy stabilizes and almost everybody starts following good ESG guidelines, there may not be any difference between being ESG good versus ESG bad. Obviously, that's a hypothesis. Another point that we'd like to point out is that what does ESG good being versus being ESG bad? How do you measure that? We have to come up with indexes, and the indexes are not necessarily consistent. Both myself and my colleagues will spend more time on that. If we turn to page 5, here we point out that the market has evolved over the last handful of decades, if you will. If we go back to the 1970s, Milton Friedman would have said that the only job of corporate management is to maximize shareholder value, not stakeholder value. And by stakeholder, what we mean, academically speaking, is not only shareholders, but also employees, the environment, the government, regulators, and the like. If we fast forward to the current environment, more and more business people and academics are talking about optimizing the interest of all stakeholders. And prominent business figures such as Larry Fink and Jamie Dimon have also supported that move. So therefore, this slide does highlight the fact that the environment has changed over the last several decades. If we turn to page 6, Duncan, this slide underscores the point that ESG shocks may have financial repercussions. For example, at the beginning of the 20th century, the San Francisco earthquake, which you would obviously consider as an environmental disaster, did cause a Wall Street panic because many of the insurance companies started selling their stocks to pay off their liabilities to the various sufferers of the earthquake. In that regard, many of the central banks, including the Bank of England and the Federal Reserve, have started research groups tracking environmental risks and what that might do to financial risk, and in addition to this historical experience. If you turn to page 7, we like to point out that, as I said before, there are various indexes that measure ESG performance, and these indexes differ. How do they differ? Well, they differ in terms of the number of variables they include, the quantitative values that they assign to these variables, and how they weigh these variables in the index. And finally, on page 8, regarding the empirical evidence of the academic literature, the survey of the literature, we do point out a couple of instances, for example, where TIA-CREF, their ESG good fund, had a lower return than comparable funds. And this is one of the most important areas in research right now, whether ESG good investors have better returns than non-ESG good investors. Again, most of the literature is pointing out that if you're an ESG good investor as opposed to an ESG good company, you're more likely to have lower returns than otherwise. And that's understandable because investing in an ESG good type of index makes you feel better. So in a nutshell, that's the summary of the empirical evidence. Having said that, I can pass on the baton to my colleagues.
So, hello everybody, I'm Konstantin Semyonov. I'll start on page 10. And we have a number of pages, or just a couple of pages, related to the ESG landscape from the institutional perspective. Page 10 shows an explosive growth of ESG importance for capital markets. The upper left chart shows the issuance of green bonds. It reached nearly 280 billion in 2020. Significant portion of that was overseas, specifically in Europe, but one of the largest issuers of green bonds is actually the utility sector globally. The upper right chart shows asset under management at managers who are signatories to United Nations principles of responsible investing. The signatories are adherent to the proliferation of ESG principles and are subject to certain reporting standards. By the end of 2020, those firms managed an unbelievable 100 trillion in assets globally. Bottom left is from a survey of banks performed by Fitch. The sectors most likely to face negative screening from banks in terms of loan products are metals and mining, presumably for environmental risks, and also gaming and leisure due to social risks such as gambling addiction and possibly money laundering. Utilities are actually in the middle of the pack there in that survey. From a regional perspective, one can see that Western European banking groups are generally more likely to apply ESG policies to their financing and underwriting compared to banking groups based in North America. Finally, the bottom right chart documents a number of sustainable funds launched in the US. After 2015, there is clearly a shift upward in the numbers. Moving on to page 11. This page is largely here for your reference. We listed some of the ESG standard setters. And there are global and US agencies and programs which set rules and standards in the ESG world. I already mentioned the United Nations. Sustainable Accounting Standards Board is often referred to as a body which develops standards of sustainability similar to accounting standards issued by GAAP. Notably, there is a number of SEC initiatives which we also list here and which are ongoing currently. Moving on to page 12, Here we discuss characteristics of major ESG agencies, those which assign scores to corporates, including utilities. With the exception of ISS, their ESG scores are available to Bloomberg subscribers. So any capital market participant, any analyst in a bank or investor can see those scores on the Bloomberg station. So quickly going through the 4 of them. SAM is a former Arabica SAM. It's now part of S&P Global, and its scores are used in the construction of Dow sustainability indices. Sustainalytics is owned by Morningstar. Its other product is as the second opinion for green and social bond issuance. MSCI uses its ESG scores for its own set of sustainability indices. And ISS is very well known for its governance scores and has been around for decades, certainly longer than I've been watching the markets. And after recent acquisitions, the agency also started providing ESG scores similar to the other 3. Moving on to page 13, here we, on page 13, we present 3 popular families of sustainability equity indices. As mentioned before, MSCI and Dow use their own respective ESG scores, while FTSE, which is a British agency, nevertheless very important, that the one of the agencies affiliated with Financial Times, they appear to be more of an exclusion index, where they just exclude certain indices because they are exclude certain stocks rather because they are, as Nisa said, sin stocks in their view. We know that all 3 indices put significant weight on technology names, and also another note here that inclusion of a particular corporate name into an index is often a big media event for the respective company, as it signifies its ESG effort. Moving to page 14, here we continue to talk about the 3 equity indices, these sustainability indices. All 3 indices underperformed S&P 500 on a cumulative basis over a long horizon. That's on the left chart, and S&P is purple line here. On the annual basis, however, now focusing on the right chart, it appears that sustainability indices perform better during volatile times. I would add, in 2021, all 3 sustainability indices outperform S&P 500. Sustainability indices also outperformed in 2009 and 2020 largely, and also starting from 2016 on a cumulative basis. That's a little chart on top of the left chart. It is possible, as always in the world of finance, that outperformance may be driven by numerous factors, such as growing ESG popularity among equity investors, as well as high weight of those indices on tech companies. Changing gears slightly, we would discuss the analysis we do at Ramirez. On page 15, we show numeric scores from SAM and Sustainalytics for US regulated electric utilities ordered by the Sustainalytics score. The only name which we add here is Iberdrola. Obviously, it's a Spanish utility, but we added it for comparison and contrast. Also, it's a majority owner of Avangrid of Northeast. The data, as I said, are sourced from Bloomberg. And we notice here that it's absent for smaller cap utilities, just probably because Bloomberg does not have data capacity or desire to put those in. We can see significant variation in the scores. The Iberdrola example suggests that a utility may have nearly perfect score, close to 100, despite inevitably high environmental impact of the industry as a whole. On the top right chart, the scores from the two agencies are correlated, but not at all perfectly. The divergence likely occurs because of three main reasons: different scope of categories among the agencies, even though largely it's three categories, E, S, and G. Different measurement, certainly, and different weights of categories. Also, the bottom chart suggests that market cap and ESG scores seem to have no correlation. Therefore, small company may have a high score. It's not just a matter of size, it's really a matter of effort, it appears. Moving on to page 16, here we looked at the same universe of utilities from page 15, and we report correlations between those ESG scores and various capital markets parameters for the universe of those utilities. Our initial hypothesis here is that high ESG scores should be associated with lower risk, as Niso said before, such as lower cost of capital, but not necessarily higher returns and valuations. So we observe, for example, that higher Sustainalytics SAM score generally correlate with higher borrowing costs, contrary to our intuition. The relationship between ESG scores and P ratios is weak. Returns correlate positively to Sustainalytics social scores, and so on and so forth. So that's a fair bit of data mining, which we present here. With that, I'll pass the next part of the presentation to Duncan. Thank you very much.
Hi, everyone. So the impetus for this presentation was to take advantage of some new data available to the world at large. In particular, if we move to page 18, a template that had been put together by the Edison Electric Institute. And this template is the result of a collaboration of this institute with a number of major utilities. At the time this was put together, I believe there were 23 utilities contributing data, and perhaps more that were contributing efforts to designing the template and coming up with it. And the result of this effort was a template, and for the past few years, various utilities around the country, the US, have been filling them out and giving them to EEI. And we've taken the effort of compiling all of these results and sussing out what analysis we can from it. And looking at this here, we're just picking a sample template from the old generic utility. And as you can see from this template here, it's divided into three major sections. One is generation portfolio, and I think it's fairly self-explanatory. Basically, you've got a mix of energy and how is it categorized, what quantities. And one thing worth mentioning here is that the template divides this up according to whether it is the nameplate figure, which is how much megawatts perhaps a facility can generate according to the nameplate on the side. There is owned generation, which is, just as it would seem, the amount of generation from facilities you own. And then purchased, which is energy perhaps purchased from another utility. And then there's total, which is owned plus purchase. It does not involve nameplate. that should be reasonably straightforward. So that's the first section and the major section. And then the next section is emissions, where the generation mix itself is disregarded and is straight numbers on carbon dioxide and equivalents, nitrogen oxide, sulfur dioxide, and mercury. So nitrogen oxide, sulfur dioxide, mercury are typically byproducts from coal, using coal in your generation mix. And then lastly, there's resources. Resources here is really divided into two parts: human resources and then natural resources. And should be reasonably straightforward if you were to look at that section. Human resources encompasses number of employees, directors, and so forth. And resources covers how much fresh water is consumed or polluted. So when bringing this back to ESG of course stands for environment, social, and governance. This has to be matched up with the template that we have available to us. And the E is fairly well covered by generation portfolio and emissions, and even part of the natural resources section. But the S, the social, and the G, the governance, is largely unaddressed here. So when it comes to crunching the numbers and trying to figure out some analysis to build around this, we aren't capturing the full ESG. We're only mostly capturing E. So going to the next page, we want to combine this data with market data, observable market data. And we picked 5 bits of market data that we want to compare against this ESG data per EEI. And we have picked bond yields. We've picked forecasted PE ratios 1 year ahead. We've picked betas, so 1 year daily betas, measure of equity risk. We've picked returns, basically at the time that we are looking at this data, how returns look like for a particular company over the preceding year. And then volatility, which is the volatility of the stock price. So to compare the market data to the ESG data, we run a number of regressions, hundreds actually. And the method is very simple. We basically take a single ESG metric, which might be what portion of your generation mix might be natural gas, and see if we can statistically correlate it to one of these market metrics here, perhaps bond yields. And when you take all of the ways you can, combinations of market data against ESG factors, you end up running a number of regressions. And from those regressions, we can then back out if the relationship between the ESG metric and the market metric is meaningful. And there are 2 ways we can do it. We can observe data at one point in time, which is one way of doing it. And then we can do it another way, which is take a look at the changes from one period to the next. This is yearly data, so we might be interested in how the generation mix changed from 2017 to 2018, and perhaps it'll give us some information on how returns have changed from one year and the other. And measuring things in changes is our gold standard, but it's unfortunately due to how old the EEI template program is, it's our ability to do work there over time is limited. So here on page 20, we have a color coding of the information from that we've gleaned from these regressions. So we've got lots of boxes here. Some are blank and some are colorful. And the idea is that each box, whether or not it has a color in it, represents a relationship between an ESG variable and a market variable. So if you were to take a look on the table on the left, on the top row, CO2 intensity owned, and then looked across the columns, we get to PE 1 year forward. So that box is colorful, and it means that when we run a regression between PE ratios and CO2 intensity, we have found something meaningful. If there's no color, it means we couldn't detect anything. And the intensity of the color, a deep red or a deep green, means that we found a very strong relationship, and a lighter color means no relation, less significant relationship. No color means no relationship. And the green and the red basically means that for a green relationship, we found a positive relationship, which doesn't necessarily mean some sort of moral judgment. It means that as one goes up, the other goes up, or as one goes down, the other goes down. So again, using CO2 intensity and the very top left there against PEs 1 year forward, the dark green means that we found a very significant relationship, and we suspect that CO2 intensity, as it is higher, so is PE. So it raises PE perhaps. By contrast, 3 lines below it, CO2 intensity total, when compared to yields, it seems that as CO2 intensity total goes up, yields may go down. That's what we've statistically gleaned. So we can run these regressions for all these combinations, and where we see color is where we found something interesting. So our first observation, first of all, is that we've again got it as it's listed in the template, everything grouped by emissions, resources, and generation. And starting with emissions, we see largely the most color, and most notably, PE ratios seem to be lifted as carbon intensity goes up and as pollution measures from coal go up. Similarly for yields, as CO2 intensity goes up, it appears that yields go down. Moving on to resources, we find there's nothing there statistically. And it's unfortunate because in the resources that encompasses what little we have for the S and G of ES and G. So unfortunately, we can't say anything deep about it. I should point out that simply because we can't observe something statistically does not mean a relationship is there. It simply means we can't see it. It could indeed be there. We can't see it. Moving over to the right column in generation, a lot of the coloring is concentrated on the top, where we look at generation mix, and in particular, nameplate generation mix and owned generation mix. Purchased, which is further down in total, seems to be less significant. But again, looking at the nameplate and owned, we see a lot of color in the PE column. And we see that in particular for owned coal and owned natural gas, as you have more of that in your generation mix, PEs seem to go up. And for nuclear, either nameplate or owned, it seems to be, PEs seem to be lower. And we also notice effects on yield when it comes to natural gas and nuclear, and some effects on returns. But otherwise, the coloring is fairly sparse. And down below, we see some other, down in the total section, some other influence on returns and beta, but it's rather sporadic. Going to the next slide. So this, before I get to the next slide, this here was all measured at a moment in time in 2018. So it's not our gold standard way of seeing if changes from year to year correspond to changes, changes in year to year of ESG data corresponds to changes in financial measures, but we'll get to that on the next slide. So on the next slide, we see there's less going on. In particular for emissions, we see there's really only one measure. And for resources, we see there's one measure. And I'm not going to focus on them since there's a certain degree of missing robustness. We hope to see that as related pollution or emissions metrics go up. If one goes up, the rest of the related ones should go up, and we don't observe that here. However, if we look at the generation section on the right, we do see that some themes start to emerge. So for PEs, as we noticed before, there was some relationship with natural gas, and we again see it here. It seems that as your mix of natural gas goes up from year to year, so do PEs. And again, as observed before, as your natural gas mix goes up, the owned portion, yields seem to go down.
Mr. Chairman, this is Commissioner Fielder. I wonder if I might ask a question.
Yes, of course.
Thank you. I just want to be clear what we're looking at here on this slide, page 20, and the little box at the bottom that's significant at P. Is that P, does that represent your confidence interval in your statistical analysis?
It is related to confidence intervals. So a confidence interval is a interval. When we run a regression, there's a coefficient that we estimate from that regression that in this
Okay.
case here would
Yeah.
represent.
I thought that's what it was. I was curious about that because I see that you're using confidence intervals that are not typically used in peer-reviewed analysis. For example, the P equals 0.05 is the standard, and you've used P equals 0.01 and P equals 0.1. And I'm wondering why you use such a wide range of confidence intervals when that 0.01 oftentimes would reveal no statistical significance, whereas 0.05 is the standard in academia and has been for many, many decades.
I suppose there are different areas of academia. I come from mathematics, but although 0.05 might be the standard here and there, I don't believe it's the standard everywhere. And a lot of research involving regressions in statistics will use a strike of p-values to show which relationships might be stronger than others. That said, if you if anybody wishes to focus on 0.05, it's there, and we're just trying to give some sense of the intensity of the relationship. Not to discredit or suggest anything more. And guess what else? I would also say in academic literature, picking 0.05 might be perhaps a standard, but the choice is, how to put it, choice might be sensible, but there's no reason to consider other values. Does that answer the concern?
Well, I think you answered my question. Thank you.
Okay.
It does not answer my concern, but I think you've answered my question.
Fair enough. Continuing on, looking on the left side, we've somewhat ignored it just due to lack of robustness, as we hope to see some relationships between related metrics. We don't really see them here. On the right-hand side, for natural gas, we notice, as we noticed before, that there seems to be a positive relationship with Ps, a negative relationship with yields. And as we go further down to the purchase section, we also notice there's some significance there. The one thing that appears to be absent, with the exception of total renewables, which is on the lower right-hand side, purchase total renewables, there's a significant relationship at P equal to 0.05, and it does seem to suggest that betas might go down. So it seems that perhaps having more renewables in your mix may actually decrease your equity risks. Going to the next page, this is basically a summary of the takeaways. So under emissions, here we just focus on the relationships that we see. Again, with carbon intensity, we see a positive relationship with PEs. One reason might be that the short-term costs are lower. It's indicates a certain degree of reliability, and this also may involve off-peak facilities, perhaps factoring into the equation. And we can go through the whole list here, but I won't go through every single line, except to say that PE yields tend to come out as the most significantly affected things, and we can guess why. And occasionally we see effects on betas and less so on returns and volatility. So the takeaway, if to summarize it in only a few words, is that the E of ESG is very important and of obvious important utilities, and the S and G part of ESG is not important as we see it. That could mean that we can't detect significance, but it exists. And it also, it's not heavily covered by the EEI template. And as my colleague Constantine noted, there may be little variance between the utilities when it comes to S&G related measures due to regulation and largely similar practices. Again, we notice looking at this table above that renewable generation mix is not prominent, and that may actually be a good thing in some sense, in this sense that there are added costs to deploying renewables for utilities that deploy more carbon intense methods. It is a cost to transition from one to the other, and those added costs might practically have a deleterious effect on some of these measures, but we do not detect that it in fact does. So it seems there is no harm statistically, as we can detect from the EEI data, to transitioning to heavier amount of renewables.
So if I could just summarize this work real quickly, I would say that of the environmental data we regressed, there's a meaningful and positive relationship between fossil-based fuels in a company's generation portfolio and its PEs. But a company whose fossil fuel generation is derived from coal exhibit higher debt and equity capital costs. And in our view, that's very insightful. And it says to us that the conversation of natural gas being displaced fully by renewable power, that is 100% electrification, is not for the foreseeable future anyway, being taken very seriously by investors. Further, it says to us that the capital markets are placing substantial value on natural gas as the fuel of choice and is critical to the nation's energy transition. So really what it says is that natural gas, from a statistical standpoint, and this is just the data, is kind of in the sweet spot right now of a utility company's or a generation company's fuel mix as we work our way through this energy transition. Is there any comments or questions or concerns that anyone might have that we could answer?
Any of my colleagues have questions, or PSC staff? I'll just ask a little primer question. First, thank you for your time in making this presentation, and thank you for that summation, by the way. I thought that was very informative. But let's just back it up a little bit to talk about what ESG is. So as I understand it, as it presently stands, ESG metrics are really not a common part of mandatory financial reporting, but this kind of information is something that companies are in, publicly traded companies particularly, are increasingly making disclosures about in their annual reports, correct?
Yes, that is correct. And there is no mandatory reporting requirements coming from any kind of official type of government or agency in any strict sense. But what there is now, and there hasn't been up until a few years ago, is investors are now asking a lot of questions about what companies' ESG policies and practices are. So, you know, to some degree, the market is now creating this requirement around ESG reporting and practices.
And if I may add to that, as I mentioned, we when we sit at our desks, we can see ESG scores on Bloomberg. So it's a third-party information. Certainly, it's based on the willingness of the company to work with those agencies, such as Sustainalytics. So it's a two-way street, or it is supposed to be one. But we and any investor, pretty much any investor in the land, can see those scores and make certain inferences. And those scores, among other things, are based on the clarity of companies' disclosure, because some of them are sort of done privately without the company being involved.
So the way, Ray, it's my, you know, I'm admittedly a bit of a novice in this area, so part of the reason I asked you to make this presentation, but the way I understand what's happening is essentially investors are looking for, and this is a general statement, of course, but investors are looking for companies that they often find have good ESG scores, correct?
Correct.
And so as you walk through in the mechanics of your results here, for example, it's on the screen. As investors start moving their investor dollars into companies that have good ESG scores, that is going to have an impact on, presumably, on how utilities companies build their generation portfolio or how they operate, correct? You'd agree with me?
That's correct. That's correct. And you know, to Constantine's point about ESG scores being kind of fully transparent and available on Bloomberg. Bloomberg is an information machine that all financial market participants use, and you can pull up the name of any company, XYZ company, and have their ESG scores immediately available to you. And you'll have investors that will say, we're only going to buy the securities, debt or equity securities of companies that have a threshold score. And the higher the score, and the more you meet that threshold, the lower the capital costs are going to be for that company, because their securities are more in demand than non-good ESG companies. So you know, you're right. Utility companies now want to have as high as ESG scores as possible within some reason, without debilitating their own companies in terms of kind of, you know, too high capital costs, because they are, you know, they're unbalanced in terms of what their portfolio of resources look like, in order to maximize their financing costs.
So following up on that, Ray, this is more perhaps a statement than a question, but you're certainly free to elucidate on it. So as Ray, obviously we come from this from a regulatory perspective as the Public Service Commission of Montana. And so what I would expect to see then as a commissioner is that our regulated utilities here in Montana, when they engage in their resource planning process, are going to be taking these factors into account moving forward. And we should see utilities companies resources planning respond to essentially these types of metrics, correct? Due to the investors.
Yes, but these are not the only metrics. Having high ESG scores are good, but not at the risk of having a portfolio of assets that may not kind of meet the mix and the balance of what is required to service the service territory. I mean, you could have an ESG score of 100 with a portfolio of all wind power and solar power, but you're advantaging your ESG score for the sake of affordability and reliability and resilience, which we now know is, we've always known, but after the last couple of years of some of the events that have taken place kind of, in the South and the Southwest and in Europe, that a portfolio too heavily weighted towards renewables is not optimal. So, I think that the takeaway of this analysis is that having natural gas as a resource in your fuel mix balances out the concerns of ESG investors and investors who are primarily interested in financial returns, because you do have a very low carbon intensity with your natural gas generation, certainly the lowest of all the fossil fuels, while at the same time you're retaining affordability and reliability.
Right, might add that when we talk about ESG scores, and there's been a lot of complaining that ESG scores might not actually correspond accurately to how ESG friendly a company might be. There might be some disconnect. Part of the impetus of looking at the EEI data directly is that there's, unless the numbers reported are incorrect, it's straight from the source, so to speak. And between EEI and Bloomberg having made rather extraordinary efforts, using this raw data is somewhat novel in the academic literature. Sometimes there might be focus on one particular bit of raw unprocessed data, but this deploys everything we've got available in the EEI data. So there's no fudging the numbers here, really.
So basically what Duncan is trying to say, and he said it, I'll say it more directly, is that some of these ESG rating agencies are fickle, and an ESG rating agency will give you a better score if you spend more time with them. And the more resource and time and dedication you provide one ESG rating agency may not be able to be the same amount of time you dedicate to another ESG rating agency. So, the degree to which these ESG scores coming from these agencies are reliable, we think that they're pretty reliable, but they're not, they're not perfect. Whereas our analysis is it's just data. It's a statistical analysis. I don't know if that makes sense at all.
Neil?
Yeah, if I may have a question. I'm an analyst here at the Montana Public Service Commission. And so what I have to do, my job is evaluate some of the proposals of utilities and the interveners that contest the proposals. So are you contending that if they have utility has a high ESG score, they can get a lower cost of capital? And if so, can they demonstrate that and show the commission that customers will save through the acquisition of a certain type of portfolio?
Well, I think theoretically, yes. but there's a lot of factors that go into, well, certainly, to the point that was made by NISO earlier about being ESG good and ESG bad, that you certainly don't want an ESG bad score, because that's like, not being dressed appropriately at work. You will get punished for that. Now, can we say that your cost of capital with with high ESG scores is going to be minimized? I think we have less confidence in being able to say that. But again, to go back to kind of the data, and we're just looking at the data, it seems to be that natural gas in your fuel mix provides a balance between being environmentally friendly and responsible to a large degree, and still providing the benefits of reliability and affordability.
I might add
Let
one.
me add a couple more points to that, if I may. First, there's theory, and then there's the empirical evidence. Clearly, theoretically speaking, being ESG good, as we said before, lowers tail risk and therefore the cost of capital, especially debt capital, but also equity capital. Now, when it comes to the empirical evidence for ESG is relatively sparse and relatively new, unlike, for example, sin stocks that have been in existence for many, many more years. Having said that, another way of looking at it is if a company wants to be ESG good, they will have to invest in a lot of CapEx. So they will have to raise funds and invest in CapEx. So even if they benefit for it in the long term by having a lower cost of capital, they do need to undertake capital expenditures to achieve better ESG scores. That's one way of looking at it. Another way of looking at it.
Thank you.
And to just re-emphasize something I said earlier that might partly address your question. We don't see renewables coming up as something colorful on the charts we saw before. So what it does mean on the positive side is that it appears that transitioning generation mix to towards renewables doesn't appear to hurt any of the financial performance metrics. And when you consider that time and effort and money that goes into transitioning, that's meaningful.
Thank you.
Other questions?
Mr. Chairman, I will go again if no one else is needing to jump in.
Go ahead, please.
Thank you. This is Commissioner Fielder once again. I'm just wondering whether or not the analysts here that gave the presentation are aware of I suppose it's a movement afoot from several state treasurers that have, I think, indicated that they are not going to bank state funds with companies that are using ESG standards in rating whether or not they're going to issue loans to companies and that type of thing. Are you gentlemen aware of that issue, and do you see it having any impact on what you're reporting here today?
I'll just mention a practical matter. The data here is not current, and I would suspect predates a lot of those conversations. And it's not current because we don't care. It's just taken some time for EEI data to arrive and be reported. There's about a year or two delay between one and the other. So this might not yet be reflective of those conversations.
If I may add one more point, if I understand the question correctly, the implication of the question is that ESG is not only an economic or financial question, but it's also a political question. So from that point of view, there is a political tug of war that is going on and may keep going on. So without taking sides, it's important to note that this is a political question.
That is correct. Thank you.
Additional questions for our presenters? Doesn't look like it. Ray, do you want to do any concluding remarks?
Well, you know, we appreciate very much the opportunity to have this conversation with you today and with the commission. You know, the whole conversation around ESG is very much an evolving conversation. You know, the degree to which you would like to revisit this conversation in the future, we'd be happy to do that. We spend a lot of time with utility companies and regulators across the country on this topic. And we would be happy to update you on some of these findings as we move forward.
Appreciate that, Ray. Well, thank you for your time today. We appreciate the information and the opportunity to learn. And we hope you're having a great new year so far, and best wishes to you.
Chairman Brown, thank you very much, and Commissioner Fielder as well, and staff. We appreciate the opportunity to have this discussion today.
And thank you.
Thank you, Ray.
Thank
Yep,
you.
I appreciate it as well. Thank you very much.
Thank you.